corporate tax gap is about $42 billion per year. And the IRS does attempt to identify and collect that underreported income. And they are sometimes successful, but they end up collecting only about a quarter of the US corporate income tax gap. And part of this is because the level of resources enable them to only audit about 10% of large corporate returns. And of the returns that they audit, they only propose adjustments for about 60% of those returns. And then we also know that not only is the IRS resource constrained, but state, local, and foreign tax authorities also face resource constraints. And so because of these resource constraints, aggressive tax positions often go unchallenged. And just to give you an idea about the frequency and magnitude of these unchallenged tax positions, this is one of the figures from our paper. And as you can see, among the CompuStat firms that could report an unchallenged tax position, about half report unchallenged tax positions each year. And so obviously this means that unchallenged tax positions are common, and they're also economically significant. And so this figure shows the aggregate unchallenged tax positions reported by CompuStat firms each year. And as you can see here, the aggregate amount of unchallenged tax positions is in the billions of dollars each year. So again, unchallenged tax positions are common and they're also economically significant. And so given the prevalence and the magnitude of these unchallenged tax positions, what we're interested in this study is trying to understand how or whether and how firms change their behavior after experiencing an unchallenged tax position. And so our specific research question is whether unchallenged tax positions affect corporate tax aggressiveness or future corporate tax aggressiveness. Before I talk about our predictions, our specific predictions, I want to spend a little bit of time summarizing what we know from the prior literature about this topic. And so everyone on this call is obviously familiar with the Allingham and Sandmoth framework, but this theory predicts that taxpayer expectations about audit detection risk are going to affect the taxpayer's decision of whether to claim an aggressive tax position. And empirical research generally supports this theory. And so I've listed a few of the papers here, but Hoops et al. 2012 finds that firms that have a higher ex-ante threat of audit claims less aggressive tax positions. Jason DeBacker and his co-authors in 2015 had US tax return data, and they found that after a firm is audited by the tax authority, they initially become more tax aggressive, and they over time become less aggressive as the perception of an audit increases over time. And they refer to this as the bomb crater effect. And then finally, Finley 2019 conditions the effect of an audit on whether the settlement paid to the tax authority is favorable or unfavorable. Now, firms don't have to disclose whether a settlement is favorable or unfavorable in their financial statements. And there's also some debate over what would be considered favorable, how we determine favorability. But what he develops a methodology for estimating whether a settlement is favorable or unfavorable. And he finds that firms that have a favorable tax audit settlement become more aggressive, which is, I think, what most we would expect, but they become more aggressive after a favorable settlement. But firms that have an unfavorable tax settlement maintain their level of tax aggressiveness after an audit. And so these studies focus on the incidence of an audit. So what is the effect of an audit on taxpayer behavior? And so in this paper, we argue that the occurrence of an unchallenged tax position can also affect firms' expectations about detection risk and therefore their future behavior. And so we have a three-sided prediction for the effect of unchallenged tax positions on corporate behavior. And we base these expectations or these predictions on a firm's expectations about detection risk. And so first, an unchallenged tax position could increase tax aggressiveness. This would be consistent with the Finley 2019 result. So if the tax position revises the firm's beliefs about detection risk downward, then they could become more aggressive after a position goes unchallenged. And again, this would be consistent with the Finley 2019 result. It's also possible that an unchallenged tax position might not affect firm behavior. And we expect this because it's possible that the firm already perceived low detection risk prior to the tax position going unchallenged. So if I'm a corporation operating in the state of Georgia and I claimed an aggressive position on my Georgia tax return, and I perceived that my probability of audit was already very low, if the position goes unchallenged, my priors might not be changed very much. So that might indicate that we would not observe a change in tax aggressiveness. But finally, there's also a possibility, because of the unique nature, the institutional details here, that these unchallenged tax positions could decrease the level of tax aggressiveness. And the idea here is that because US GAAP requires firms to report these unchallenged tax positions in their public financial statements, not only are these disclosures available to investors, but they're also available to tax authorities. And we know from Bosnick et al. That the IRS does download firms' financial statements. And so if this increases a firm's perceived risk of detection or perceived risk of future audits, because they believe that the tax authority scrutiny is going to increase if they disclose an unchallenged tax position, we might actually find a decrease in tax aggressiveness. And so because we have a three-sided prediction, we're going to state our hypothesis in the null, which is that firms do not alter their tax aggressiveness after a tax position goes unchallenged by the tax authority. Okay, so I'm going to now talk a little bit about how we're going to test this hypothesis. And so at a high level, we're going to proxy or operationalize our unchallenged tax positions using UTB releases due to lapses in the statute of limitations. And I'll talk about that on the next slide. And then we're going to proxy future tax aggressiveness as cash effective tax rates. Okay, like I said, before I get to our model, I want to talk a little bit more about these UTB releases due to the lapses in the statute of limitations, because this is what's going to allow us to test this research question. And so most of you are already familiar with the term statute of limitations, but it's the period during which a tax authority is able to audit a taxpayer's tax return. And after that period, the tax authority is no longer able to audit the taxpayer's tax return unless a fraudulent tax position was involved in which the statute of limitations is indefinite, or if the statute of limitations is extended between the IRS or the tax authority and the taxpayer. And so I've listed here or provided here the ExxonMobil UTB reconciliation. And so the way we're going to measure our unchallenged tax positions are the line item here, which I've put a bar around it, but reductions due to the lapse of the statute of limitations. So this is how we're going to define our unchallenged tax positions. And one thing I'll note here is you'll note in 2020, the magnitude of that lapse due to the statute of limitations is actually greater than the reduction due to settlements with tax authorities. Okay, moving on to our model. So this is the model that we're going to use to test our hypothesis. It's a generalized difference in differences model, and our dependent variable is the cash ETR, which is cash taxes paid, scaled by pre-tax income less special items. Treatment is going to be equal to 1 for firms that experience a large lapse during our sample period and 0 otherwise. And so control firms are going to be firms that do not experience any large lapses during the sample period. As we talk about in the paper, we focus on large lapses because we think that those are going to be the ones that are of greatest interest to tax authorities, and they are more likely to affect future future behavior. And then our post variable is equal to 1 for treatment firms starting in the year of their large lapse and 0 otherwise. One thing I'll note is that because year T is kind of a mixed year, so the lapse happens during the year, we run our model both with the treatment year included and without the treatment year included and find consistent results. Our model focuses on the observations 3 years before and 3 years after the large lapse for treatment firms. And so we do this to isolate the effect of the large lapse. We also require treatment firms to have observations both in year T-1 and year T+1. We exclude treatment firms that have any large tax settlements during the 3 years prior to the large lapse or in the year of the large lapse. And we do this based on the Finley 2019 result that firms could change their behavior after a tax settlement. We include control variables from Dyring et al., and we also include year fixed effects and either industry or firm fixed effects in the model. And so our variable of interest is the beta-1 treatment post interaction. And we would interpret a positive beta-1 coefficient as evidence that firms are less aggressive after a tax position goes unchallenged relative to the control firms. In terms of our sample, I'll briefly highlight a few things. One is that our sample starts in 2007 because that's when the FIN 48 disclosures are available. They start in 2007 and we end in 2019. We require years to have either a beginning UTB balance or a current year increase in year T-4. We require the UTB reconciliation to foot to reconcile, and this leaves us with a sample for our determinants analysis of about 19,000 observations. I'll talk about that a little bit more in the next slide. And then for our hypothesis tests, that leaves us with about 8,300 firm year observations. All right, so in terms of the large lapses, before we get into our hypothesis test, one thing that we were interested in is just looking at kind of an exploratory analysis of what are the determinants of a firm having a large lapse. And so what we find here, and consistent with our expectations, is that unchallenged tax positions are more likely when a firm claims less aggressive tax positions, when the tax authority has fewer resources, and when the firm has a more extensive geographic footprint. And these results are consistent. This is there's the incidence of a large lapse, but our results are also consistent when we examine the magnitude of large lapses. So again, this was more of an exploratory analysis just to understand a little bit more about when firms are more likely to have unchallenged tax positions. In terms of our hypothesis tests, these are our main results. And so as you can see here, the treatment post coefficient is positive and significant. And so this is consistent with firms becoming less tax aggressive after they experience a large lapse. And going back to the predictions, when I was talking about the predictions, this is consistent with the disclosure effect. And what I mean here is that this suggests that firms are concerned that when they have an unchallenged tax position and they have to disclose that unchallenged tax position in their financial statements, they are concerned that tax authorities can also observe those disclosures, and that could increase their risk of future audit. But to further try to understand whether our results are consistent with the disclosure effect, if that's what's driving our results, we run a cross-sectional test where we compare domestic firms and multinational firms. And so the idea here is that for domestic firms, those UTBs are going to include federal or state positions, whereas a multinational firm's UTBs can include federal, state, or foreign tax positions. And so we expect that domestic firms' UTB lapse disclosures are likely more informative to the tax authority because the position is more likely to be attributed to the tax authority's jurisdiction. And so these are our results. And the main coefficient of interest is the three-way interaction. And so what we find here, at least with our firm fixed effect specifications, is that the results do look like they are stronger for domestic firms, which is consistent with the disclosure effect. And so this is a new analysis that we added into this draft of the paper, but based on some of the feedback that we've gotten, one thing that we were interested in is that because our results suggest that firms anticipate greater tax authority scrutiny, we kind of wanted to look at what are the tax authority responses to these unchallenged tax position disclosures. And so we measure tax authority scrutiny in three ways. And so just to summarize our results, what we find is that after firms disclose their unchallenged tax positions, the IRS downloads of firms' Form 10Ks increases, mentions of IRS audits in the tax footnotes increase, which indicates that the IRS is more likely to be auditing you after you've disclosed one of these positions or an unchallenged tax positions in your financial statements. But interestingly, the magnitude of the settlements paid to tax authorities does not change. And so the way we interpret these results collectively is that IRS scrutiny does appear to increase following disclosures of unchallenged tax positions, but this increased scrutiny does not appear to result in increased tax settlements. And I'll come back to that in just a minute. So just to conclude, we believe we're the first study to examine the determinants and consequences of unchallenged tax positions. So again, a lot of the research in this area has focused on the effect of audits on taxpayer behavior, but we don't know very much about how a tax position going unchallenged would affect taxpayer behavior. And so what we find in terms of our determinants is that unchallenged tax positions are more likely when a firm claims less aggressive positions, when the tax authority has fewer resources, and when a firm has a larger geographic footprint. We, in terms of our hypothesis tests, we find that firms become less tax aggressive after tax positions go unchallenged. And this is consistent with firms anticipating heightened scrutiny from tax authorities after disclosing or experiencing an unchallenged tax position. And so we provide some evidence in our cross-sectional tests that it's the disclosure of unchallenged tax positions in the public financial statements that plays a role in firms' responses. In terms of our contributions, again, we believe that we're the first to examine tax aggressiveness that is not challenged by the tax authority. And this is important because, as I mentioned at the beginning of my talk, the prevalence of unchallenged tax positions is very common given the limited resources or the resource constraints faced by tax authorities. And then we also find that the disclosure of these unchallenged tax positions in the financial statements could actually affect behavior. So it might be the disclosure of these positions in the financial statements that is affecting firms, the changes in behavior that we observe. But then taking a step back in terms of our policy implication, we think that one interesting insight that these results provide is that the IRS and other tax authorities might think that targeting firms that have these lapses might be instances where they've left money on the table, and so they might be more likely to audit those firms in the future. But our results suggest that it might not be fruitful to audit those firms, given that they decrease their level of tax aggressiveness after positions go unchallenged. So that's all I have. I think it was right on time. So I look forward to Simone's discussion.
Thank you, Erin. Perfect. I'll hand over the word to Simone, who's going to discuss the paper.
Okay, before I start, I would like to say thank you to Max and Pete for giving me the opportunity to discuss Erin's paper. And also I would like to say thank you to Erin and her co-authors for providing such an interesting and well-developed paper to read. So before I go into my comments, I would like to just present a brief overview of the topic discussed in the paper. And in particular, I would like to start with the accounting standard ASC 740 and 10, which requires firms to record reserves in their financial statements for those cash tax savings generated in the current period that could be challenged and denied in the future periods if audited by the tax authority. So this means that these reserves indicate tax positions for which the firms are uncertain about the appropriate tax treatment. So there are two ways in which the uncertainty can be resolved. The first is through settlements with the tax authority, and usually this comes after an audit. And the second is through the lapse of the statute of limitations that is associated with the tax position. So the latter case implies that the tax position has not been challenged, and the time that the tax authority had to challenge the tax position has expired. So therefore, the tax position is no longer uncertain, and the firm can release the reserve by removing the liability from the balance sheet. So this paper examines whether disclosing the unchallenged tax positions impacts the firm's perception of future audit risks, and whether these revised expectations about the future audit risk affect subsequently the firm's tax aggressiveness. So my first comment is about the theory and contribution, and in particular, I would like to encourage the authors to more explicitly discuss the sources of tension in relation to the prior research, and in particular with respect to this concept of perceived audit risk, because the perceived audit risk may differ between companies that are under a tax audit, or companies that have maybe just settled their tax payments with the tax authority, compared to those companies that disclose their unchallenged tax positions on their financial statements. So for example, Finlay finds that there is no effect of unfavorable tax settlements on subsequent tax aggressiveness, and other papers show that there is lower tax aggressiveness when the audit probability is higher. So my point here is more on what makes the disclosure of unchallenged tax position different from other types of outcomes in terms of the perceived audit risk. Then I have a comment about this expectation about future tax audits. This is likely to depend on whether the unchallenged tax position has been audited or not. So I have two scenarios. So if the tax position has been audited and unchallenged, then the firm has no reason to believe that the tax authority will increase its scrutiny. And I refer to this case as a no risk case. While if the position has not been audited, then disclosing an unchallenged tax position may increase the tax authority's scrutiny in future periods. And in this case, we can have some risk, some level of risk. So I encourage the authors to maybe distinguish between these two situations in that paper. Then I have a comment about whether firms learn. So the question there is, would the tax position that has just been challenged still be considered uncertain in future periods, or firms perhaps use their past experience when assessing whether the tax position is more likely than not to be sustained upon examination? So if this is the case, it may be interesting to see whether firms report less or more unrecognized tax benefits after the position has been unchallenged. Then I have a few empirical comments on the empirical approach. So the first one is about the use of this above the median unchallenged tax position to capture this enhanced, perhaps enhanced level of perceived audit risk. So the use of above the median, of the sample median, assumes that firms can monitor other firms' unchallenged tax positions before they can revise their expectation of future tax risks. However, this may not always be the case. So also the tax authority may follow a different criterion when deciding which firms to audit. So for example, they can audit larger firms, or perhaps firms with low effective tax rates. Also, the use of the above the median unchallenged tax position may not take into consideration the fact that some firms may report a one-off transaction leading to a high unchallenged tax position versus those that are persistently reporting a position that go unchallenged. So in sum, it will be helpful to examine whether this alternative measure of unchallenged tax position, such as changes, increases, or perhaps averages, would be still a good proxy, and this will also help evaluate the sensitivity of your findings. Then I have a second comment about the empirical approach. An alternative story of your paper could be that is the overall tax uncertainty driving the results rather than the specific perceived audit risk from the unchallenged tax positions. And therefore, I encourage you to control for this overall tax uncertainty, perhaps beginning UTB in the main tests. And I have this comment in particular because I saw that in table 2, firms disclosing above median unchallenged tax positions report on average larger ending balance of unrecognized tax benefits. And also UTB is a strong predictor of lapse. And therefore, just to rule out this alternative explanation, I recommend the authors to control for the overall tax uncertainty. I have a few other comments. So the first would be about reporting some additional statistics for the pre and post periods, disclosure periods, because this will give further insight into the data. The second may be about, I wonder whether there may be some tax or financial reporting incentives for releasing reserves for unchallenged tax positions, because this results in a reduction of the income tax expense. Further, I wonder whether maybe audits or settlements in peer firms can also lead the focal firm to revise their perception or their expectations about future audits, and whether the focal firm therefore will change its future behavior in terms of tax aggressiveness. Also, in some European countries, there are alternative channels of communication between the taxpayer and the tax authority. I'm not sure about in your setting, but if there are alternative communication channels where the taxpayer, for example, can ask a question to the tax authority on how to interpret a certain rule, then this can also affect like the perception of risk and also the subsequent tax aggressiveness of the firm. So overall, I found the paper very interesting and the research design very effective. The evidence provided are fairly convincing. So I wish the authors the best with the paper going forward.
Thanks a lot, Simone. Yeah, Erin, do you want to take a few minutes to respond before we move to, already have a couple of questions from the audience that I would pick up.
Well, thank you, Simone. Those comments were very helpful. We've definitely thought about some of the issues you raised before, and we'll continue to think about them. Just a couple of things. One, in terms of the tension, one thing that we think is kind of interesting is that the Finley 2019 result is that firms become more aggressive after they have a favorable audit settlement, but our results are kind of the opposite, right? So if they have an unchallenged tax position, they become less aggressive. But I agree with you. I don't know that that's coming across, at least in the intro of the paper and the front end of the paper. So we can definitely push that a little bit more. I completely take your point about positions that are audited but unchallenged versus positions that are not audited at all. Our understanding is that the lapse line on the UTB roll forward is just for positions where the return was not audited. But there are absolutely situations where a return is audited and there is no proposed deficiency and there's no settlement. Unfortunately, we can't tease that out with the existing data on the UTB roll forward. But we try to acknowledge that in the paper, but that's our understanding, is that the lapse is just the returns that have never been audited before. Funny that you said the suggestion to look at UTBs. We actually had that in the prior version of the paper, and we took the UTB hypothesis out. One thing that's kind of interesting is that the UTBs don't appear to change after an unchallenged tax position. And so we removed that from the paper because we were really interested in the actual behavior of taxpayers, at least in this draft. But we can definitely think about bringing that back in. And then your empirical suggestions are all very helpful. So thank you.
Okay, so let's start with a question from Richard Sansing, who's referring to the Ellingham-Santmo model. And let me just point out that Myra Santmo is actually a scholar of NHH. So we're very proud whenever he's mentioned. So, so Richard's comment is that the model optimal taxpayer behavior when facing a non-strategic tax authority, that means the audit probability is exogenous. When you discuss your hypothesis and results, it sounds like you are contemplating both the taxpayer and the tax authorities as optimizing players. And there seems to be a mismatch between the theoretical literature that you cite and the development of your hypothesis. And I was thinking about something similar in the sense that I guess if the IRS has limited resources, they're going to target the resources at certain firms. And I was kind of wondering if there's some anticipation of future firm behavior. So for example, if I know that a firm is going to go down in terms of tax avoidance, right, they're going to behave better from the IRS perspective, am I going to stop challenging their tax positions? in anticipation of this. I think that also refers to this.
Oh, that's really helpful. Thank you. So that's a very fair point. Would you think that maybe we should be, instead of citing Allingham and Sandmo, or in addition to citing that, we should cite more of a game theoretic model like the Greats et al. Paper, where where both the taxpayer and the tax authority are both able to move? Okay, perfect. Thank you, Richard. And Max, thank you. That's really helpful.
And then there's a question by Bridget, and maybe Bridget can just ask it herself instead of me reading it out if you're here.
Sure. Yep. Sorry, my camera's off because I have some internet difficulties. But Erin, you alluded to this in a couple of times that your construct, your theoretical construct, isn't so much that it was unchallenged, but it was some disclosure to the tax authority about the magnitude of the tax benefit associated with the unchallenged position. And so I wondered, if you could strengthen your tests a little bit more to get more cleanly at that. And one I thought I had was if you just restricted it to the Schedule UTP regime, because Schedule UTP is another way that you had something that was aggressive, that was unchallenged. So could you focus in on the Schedule UTP regime and just compare, large lapses versus small lapses or whatever you want to do? Because one alternative I think you might want to try to rule out is a firm might think, hey, I didn't get audited this year, my time is coming, right? Or like if they skip me this year, they're more likely to audit me next year. And so it's just the fact that I wasn't audited that's changing my my perception of the likelihood of detection, and not this disclosure or signaling story. So just any way that you could kind of get more cleanly at the disclosure. And I think holding things constant with the Schedule UTP era could be one way to get you a little bit closer.
That's really helpful. And we've spent a lot of time trying to figure out ways that we could really tease out this disclosure effect. I really like the idea of limiting this just to the Schedule UTP regime to see if what the results look like if we just hold, because that's enabling us to hold constant that they're having to disclose things to the IRS, or the positions to the IRS. We actually do have a test in the back end about the bomb crater effect, because originally we stated that hypothesis, that prediction in terms of we might see a decrease in aggressiveness either because of the disclosure effect or the bomb crater effect. And so that was how we had our hypothesis before. So we changed that so that we were focusing on the disclosure effect, and then we ruled out the bomb crater effect, or tried to rule out the bomb crater effect in the back end. But your comments make it sound like we need to maybe move some of that back into the front end in terms of the predictions. But yeah, thank you.
Yeah, and just one last thing to add on about prior lit. Shevlin Thornock Williams is another study that you might want to cite. It's not the same setting at all. They're looking at amnesty. But again, I was just thinking about the UTP. And if I disclose it and I don't get audited or I don't get assessed, is that some sort of firm specific amnesty, in firms' mind? So I just thought that was another related paper that probably warrants some discussion.
Yeah, that's a really cool way to think about it's kind of similar to the amnesty. So thank you.
Question by Ed. Go ahead.
Oh, hey, Erin. I have a question that is partly related to this specific paper, but really more broadly, you drawing in your expertise from tax compliance and the IRS. And so I noticed in Figure 1, where you have the aggregate UTBs, it's fairly constant across the past 10 years. And I was trying to think what my prior would have been. My prior actually would have been a big increase, just based on the discussion in the US about increasing the IRS budget a lot of notion that the IRS is outgunned. And I know, of course, the ETB is reflecting worldwide, not just US. And also just the evidence in, say for income shifting, right? Depending on which model you use, but there's some evidence that it's increasing over. So I would have expected a big increase in lapses over time but we don't see that. So I just wondering if you had any thoughts on that, or.
Yeah, that was something very surprising to me too. I wonder, I think we've done some analysis of looking at large lapses versus just lapses in general. And I can't remember what the trend looked like for large lapses, but yeah, I would have expected, especially starting in 2010, when the IRS budget just started getting slashed, that we would have seen more unchallenged tax positions. So I'll have to think more about what that means, or why we wouldn't see. Because I agree with you. I would have expected a spike, especially or just an increased trend from 2010 through the rest of our sample period.
Yeah, and there's a question from Pete. Pete, do you want to ask it yourself?
Sure. Yeah, I was just thinking about kind of this cookie jar reserving, and maybe it's for your determinants model. So not just thinking about like the tax features of what explains lapses, but maybe other financial reporting incentives. And Simone had mentioned, alluded to this as well. So kind of this idea that, you know, you set up these reserves that you might need, but maybe after 3 years, you know, the cookie jar reserve, you don't need that anymore. And so you got to wash it out somehow. And so the statute of limitations reversal is the line item where that shows up. And so in thinking about like, is this related to tax or not tax? Even just looking at like the correlation between the statute lapses and maybe increases or decreases related to prior year positions. Like if you have that, and maybe in the paper you looked at this, I don't know if it was in a footnote or something, or you tried to relate the statute lapses to other pieces of the UTB reconciliation. And I wonder to what extent is there information in this versus not? If there's not information in a company lapsing and how that affects their prior year positions, then maybe there was some non-tax reason that they initially booked that UTB. But like Simone's idea about maybe splitting the sample on audited and unchallenged versus just purely unchallenged would kind of hone in on that.
Yeah, and I wish we could I wish we could observe that. I think unfortunately in the FIN 48 reserve, the UTB roll forward, it doesn't. There's not a specific line item for firms that are or positions that are audited but not challenged. My expectations is that those would roll off, like you said, in the prior year decreases, whereas the lapses would truly be positions that are rolling off because the statute of limitations expired. But yeah, I like I said, we in the prior version of our paper, we looked at the UTBs. So what's happening with UTBs? And then interestingly, we found that UTBs do not change. So tax aggressiveness seems to decrease, but firms seem to maintain their level of UTBs. And our understanding from talking with practitioners and just some of the some articles that we've read is that firms, obviously FIN 48 requires them to put up reserves, right? They're not supposed to take audit probability into account when they're putting up their reserves, but they have a lot of incentive not to be under reserved. So there's nothing saying that they can't be over reserved. Obviously they need to get that by their, the external auditor needs to agree to whatever reserve you're putting up. But yeah, so we viewed that as consistent with, if firms are expecting that they might be audited in the future, they're going to maintain their level of reserves because they don't want to be under reserved if they are audited and in the future. So, but thank you, Pete.